Today we are talking about internal rate of return, or IRR. In this lesson, I'm going to explain what IRR is and how it's calculated step by step. Before we get started though, it's important that you know that IRR is a financial term and it's based on the concept of the time value of money. So if you're not already familiar with the time value of money and other financial terms such as net present value, then I suggest you pause here and go back and watch my series on the time value of money, and then this will make a little bit more sense. This video will basically explain when we are solving for I in our financial calculator, we are solving for internal rate of return. IRR is also sometimes known as effective annual rate or effective annual yield, depending on which side of the investment you're on. Internal rate of return is the discount rate at which the net present value equals zero. It's effectively the regression line for all of the cash flows, including the initial cash flow and the final cash flows, and accounts for the time value of money. If you recall from previous lessons, if you're solving for net present value, you would assign a discount rate. And if the net present value is positive, that means that we exceeded that benchmark rate that we wanted to make. IRR just tells you what that rate is. So let's dive right in with an example. My friend Henry finds an investment for $500,000, and that is going to be a 6-year investment. And over those 6 years, that investment is going to pay him $50,000 per year. And then at the end of the 6th year, he's going to sell it for $720,000. Now, of course, he knows he's going to make a profit, but what exactly is his rate of return? Well, let's calculate it. Well, as we know, this is a 6-year investment, and we didn't make any mention of, say, monthly payments, so we're just going to use annual compounding for this. It's a 6-year investment. We're solving for internal rate of return. Our initial investment on our present value is negative $500,000. And remember, if it's cash out of pocket, it needs to be negative. Cash into your pocket should be positive. And you have to have at least one negative cash flow and one positive cash flow in order to calculate IRR. In this case, our investment is cash out of pocket, negative $500,000. Then we have payments of positive $50,000. And that's our annuity or our steady cash flow. And then our future value at the end is a positive $720,000. Now let's punch that in our calculator and see what we get. So if 6 is our N, 500,000 change sign to negative is our present value, 50,000 positive is our payment, and 720,000 is our future value. We solve for I, and we get 15.02. Very straightforward. When you're solving for I, you're typically solving for the rate of return, which is your IRR. Now let's see how we do that in Excel. In Excel, we would just hit equals IRR, and then highlight the array. You'll notice that in Excel, it asks you to guess. And I have mixed feelings about that. That's a different discussion. But that just reinforces my point of knowing how to calculate this on your calculator and do it right every time. Let's take a look at another example. In this example, imagine your friend needs to borrow $100,000 and they agree to pay you $1,000 a month until the end of 2 years, at which point they will pay you back the $100,000. Let's take a look at how that works out. We have 24 months. We're solving for I. Our present value is our initial investment of a $100,000 loan. We're going to be receiving $1,000 in payments until we get our $100,000 back at the end of 24 months. Let's punch that into the calculator and see what happens. So in this problem, our number of periods is 24, so that's N. We have a $100,000 investment in the form of a loan, so that's cash outgoing for us. That's our present value, so we change that to negative. Then we're going to get $1,000 a month back every period until we get our $100,000 back at the end, future value. When we solve for I, you'll notice that we get 1%. But remember, this is monthly, so we have to convert that back to annual. So we solve for I, and then we hit enter, and multiply it by 12. Enter 12 times. That's the IRR of this particular investment, 12% per year. So let's bring this all together and show how IRR is related to net present value. If you recall our earlier lesson on NPV, we had an example of a $3,000 investment that paid $1,000 a year for 5 years. And in that case, our target return was 8% per year. When we discounted those back, we had a present value of $39.92, but our initial cash flow was $3,000, and so our NPV was $992. What the NPV tells us is that if our target threshold for a return on investment is 8%, then any positive net present value exceeds 8%. Well, remember, internal rate of return is the discount rate or the yield at which the net present value is 0. So we just solve for I with the actual inputs we have. So this investment is a 5-year investment, so 5N. $3,000 was our cash outlay, so that's negative, and that's our present value. We got a $1,000 payment every year. 0 was our future value. And solving for I, we get 19.86%. So again, what that tells us is if we invest $3,000 and we get 5 payments of $1,000 back, that is equal to a 19.86% return per year. Let's double check our work by checking this example with the calculator. And this time, we'll solve for present value. If we paid $39.92 for those $1,000 payments and solved, $39.92, I think it was 0.7, change sign, present value, 5 is our N, $1,000 positive cash flow would give us an 8% return. So IRR tells you what the actual yield of the investment was. Net present value tells you whether or not you have achieved the threshold that you set. But most of the time, a finance manager or an investor is going to say, hey, I'm not going to do this investment unless I make at least 8%. So the target IRR is the benchmark. If you want to know the exact IRR of the cash flow, you'd be solving for I, and that's your internal rate of return. I hope you enjoyed this lesson, and please don't forget to like and subscribe and all that. Thanks for watching.